So I'm here to talk about how MPC can be used for exchange clearing and settlement. The story starts a year ago. I was in Abu Dhabi for Abu Dhabi Finance Week. My partner got asked to host the speakers dinner for that event. At that event was David Sham. He was one of the speakers. I ended up sitting next to him at dinner, and this was November 22, right after FTX had collapsed. So the talk of the night was about how to build an exchange using MPC to make settlement trustless. Inspired by that conversation, I came back to the US and started thinking about how we could do a full technical specification for it. I took it to an entrepreneur I knew who was running an equity ATS called One Kronos. They specialize in combinatorial auctions. At the time, they happened to be the fastest growing equity venue in the US. Their advisor, Paul Milgram, had just won the Nobel Prize for combinatorial auctions in economics. So while this is an interesting topic in its own right, combinatorial auctions, that's not what this talk is about. We showed him the design. He loved it. He wanted to use this for crypto. And we agreed to license the matching technology out of his exchange and pair that with the MPC clearing and settlement layer to form a company called ParetoX. A little bit about my background. I currently run venture fund, Finality Capital. We invest in seed stage Web3 infrastructure, and particularly infrastructure built on shared security, with a special interest in MPC as well. This is a new thing for me. Prior to this, I had a 20-year career in tech and trading. As she mentioned, I founded OmniX that was acquired by Gemini. I also worked on CurrentX, which was one of the first FX exchanges, was acquired by State Street in 2007. I've been in crypto a long time as well. I've been around since the early days, like Mt. Gox and Ethereum presale and whatever. So ParetoX is an exchange that looks and feels like a traditional exchange. It's not a DEX. This isn't Uniswap. The matching engine is centralized. Only the clearing and settlement layer is decentralized. I've taken a minute to talk about the terminology. Not many people know the difference between clearing and settlement. Clearing refers to the netting of trades, any inter-ledger updates, determining the payment amounts to be sent during settlement. Settlement is the actual movement of money that takes place. When you talk about the risks associated with trading, you have settlement risk, which is the failure of one party to pay the other. And then you have default risk, which in a centrally cleared model is where the whole exchange defaults, similar to FTX. There are two models of settlement in trading. There's bilateral settlement, where one party trades directly with the other and payments go back and forth. There's a centrally cleared model where a third party kind of sits in the middle and sends the payments back and forth. Here's the historical context of kind of the risks associated with trading. 1974, you had Herstat Bank, which was shut down at the end of the European trading day. A lot of its US counterparties had sent payments in, never received payments back, resulting in like 100% loss. 1990, Drexel Burnham, similar story. 1991, BCCI, that was the bank that handled banking for terrorist and drug cartels. It was shut down by the US Justice Department, and resulting insolvency, resulted in a big loss of funds. 1994, I believe this was in Singapore, Barings Bank, a rogue trader, lost a huge amount of money, and the bank ended up becoming insolvent. So in 1997, CLS Group was formed to improve settlement for FX. And so CLS stands for Continuously Linked Settlement. And they basically handle all settlement and clearing for the FX markets. They operate at about 96% efficiency, so of all the notional amount traded, only about 4% money actually moves back and forth. Moving on to crypto, there's not enough room on this slide to put all of the various defaults of crypto exchanges, but highlighting two of the bigger ones, Mt. Gox in 2014 and FTX in 2022. And we think ParetoX is what can solve this problem for FX, separating exchange matching from the actual clearing and settlement and making clearing and settlement trustless. So the high-level architecture of this, this is a blockchain built on Eigen layer. The validator set can compute deposit addresses, it can compute signatures to affect settlement. The matching engine itself is, centralized. And why do you do it that way? It's for the efficiency. When you think about something like the NYSE or NASDAQ, those can transact at about 10 million orders per second. Something like Uniswap, can't come anywhere near that. In terms of decentralized matching, it's more expensive and it's not necessarily a good reason for it. So the internals of how this works, if you start out with the accounts, the accounts for a particular client are going to be multi-asset, multi-chain. You don't need wrapped ETH or wrapped assets to exchange on this. Client funds can be withdrawn at any time. You're not subject to various delays that you might have with another centralized counterparty. Clients can trade without accounts being fully funded. All you need to do is fund by settlement time. Each match trade is recorded on a blockchain and triggers updates to the internal ledger that the validators all keep. The open question is how much partial funding is required to begin trading. So there is some penalty if somebody fails to fully fund by settlement time. They would lose some portion of the amounts that they've funded. In terms of settlement happens automatically. The validator set moves money as needed. Clients don't need to intervene, do anything to affect settlement. The validator fund, the fund movement's controlled by MPC. The open question is, what's the best cadence for settlement? There's a natural tension between having instant settlement and having cheaper settlement. So the longer you wait, the more trades you can net. Netting efficiency makes things much cheaper. Here are the key features. By using MPC, we avoid wrapping, bridging, any type of synthetic asset. It's a non-custodial exchange. The exchange itself can't affect the transfer of any funds outside of the validator set. It's easy to use. It looks and feels like a traditional exchange. You don't have to, use your ledger and approve every trade and have the risk associated with that. It's a central limit order book. It's physical settlement. So in the context of, this is not only used for spot trading, it can also trade derivatives. You can also have this affect margin accounts. And the derivatives that it trades would settle physically, which is an important point. When you have cash settled derivatives, at times of stress, if you want to think about what Mt. Gox was pricing Bitcoin at the time, like before it went bankrupt, it was $100 or $200 above the market price. You'd always prefer to be delivered the physical commodity than be subject to any kind of price manipulation occurring on exchanges or weird things that happen on exchanges. It's possible to have a fiat bridge associated with this. So the validator set can view fiat money moving and then move crypto in response to seeing the fiat money move. Auditability, because all assets are held on chain, you can prove the reserves of any particular counterparty and the exchange itself. It offers segregated and omnibus accounts, and this is important because most institutions are regulated and they can't commingle assets. So like a traditional institution trading on Coinbase, which has a hot wallet, which is an omnibus account, that's a non-starter for a lot of larger institutions. To the extent you do use omnibus accounts, though, it makes settlement cheaper, as you don't need to actually move funds on chain for settlement. It's just an internal ledger update for the actual client's account. This is built on shared security. Why is that important? When you have a blockchain and you have to pay validators, that's pretty expensive. And shared security brings those costs down dramatically, we think. And every little bit matters in terms of the cost of trading in total. Making it as efficient as possible is very important. And the future, so the long-term vision of this exchange is to start off with crypto, but make this flow go towards traditional assets as well. So as real-world assets come on chain, this method of settlement is hopefully the future of how not only crypto markets, but traditional markets will also settle assets. Then I'll open up to questions.
Anyone have any questions? Anything related to trading MPC in the space of multi-party computation for trading platforms? I think that's kexes and texes have been quite the hot topic for a while after hacks.
Yes.
Okay.
Good morning. My name is Teck Guan from PQC. My question is more related to how the settlement is. I had the impression that the mainstream financial institutions have already moved to RTGS, real-time cross settlement, but it seems that you are still going on net settlement specifically for efficiencies in the trading itself.
Real-time settlement for most markets doesn't exist. Like for in the FX market, CLS, like that has a 5-hour daily settlement window where funds actually move. The rest of the day is just spent netting transactions. DTC in the equity world, same thing. It's a daily settlement window. Which market are you actually?
In the bank fund transfers, right?
And yeah, bank fund transfer, sure. But the point of this is that to the extent you do real-time settlement, you're going to end up not netting as much, and the expense is greater.
Yep.
And it's still an open question, like what's the right cadence to settle as far as having close to real-time settlement versus netting efficiency. So where does this exchange actually go? Like it could go down to a settlement window of 1 hour. If you're getting 90-something% settlement efficiency, maybe that's okay. But I don't think it would ever go to instant settlement just because of the netting issue.
Does anybody else have a question? If not, I'm going to ask one. No? Do you think real-time settlement is something you'd see in the future? In that when the Asian market, when something happens in the Americas or the Europes or a different subcontinent, and then the Asias wake up, the trade book order load on platforms sort of drops a domino effect on the entire world. But we see this more in crypto than we do in fiat. So.
Yeah, I mean, I don't think it would ever be instant, just because of the netting efficiency issue. And if you think about what a market maker does when they're trading, like to have tight spreads in a market makers have to be able to operate efficiently. And if they're instantly settling every one of those trades and it's happening on chain, that becomes very expensive, paying a transaction fee on Ethereum L1, for instance. So we just think it's cost prohibitive, and it would result in much wider spreads. And the natural movement is going to be towards some type of settlement window.
Have you heard of front running?
Of course, yeah.
And how does that help with the instantiation of real time to not so real time?
Well, that's one of the reasons for centralized matching, is that it makes front running harder. Of course, when you have decentralized matching, people can see the orders that are sitting there in the mempool. Your sandwich tax, front running, et cetera, which it might be fine for retail, but institutions aren't going to trade in that manner because they're very sensitive to cost of execution.
Hi, I was just curious, what kind of assets are you looking to list on this exchange, or did I miss that during the talk?
Literally any crypto asset that trades on a blockchain for which MPC can compute a signature, you can clear and settle that.
Okay.
And including any real-world assets that eventually come on chain, those will also be able to be.
But there's no concrete plans, or already specific assets that.
There are some. It's probably too early for me to talk about it. I'll let the CEO explain his plan. So.
The CEO in the house?
No, he's not. He is in New York right now.
Gotcha.
But yeah, you'll probably at some future point he'll be promoting his company. So.
We're happy to have someone like you up there even talking about this, because I think in the future, if we want mass institutional adoption, we're going to have to find some sort of checks and balances for things like this.
Yeah, I think it's a really big deal for financial markets to have something that's trustless, given all of the stuff that's happened in the past. So.
Thank you so much. Thank you.